right now, and 0.5%. Generally speaking, there's more of a positive tilt this morning, at least, towards EV makers. It's not just Tesla. Look at NIO. Look at some of the other ones out there like Fisker, Pulsar. All those other ones out there are kind of doing pretty good. So watch that particular space. Also watching what's happening with a big deal in terms of a stake being taken. And this is Warren Buffett's Berkshire Hathaway. It's taken a $4.2 billion stake in HP, the HP that makes personal computers and printers. Those shares up 14% right now. By the way, that makes their stake in HP roughly 11% of the overall company. So, Warren Buffett, not in the past known for taking stakes in energy or rather technology companies, but here we've got maybe a regime change kind of in transition right now. They're taking a look at some of those stocks. HP is up about 14% right now. And then you mentioned those cryptocurrencies and the breaking news with what the Treasury Department might be doing with some of its stance on cryptocurrencies. Remember, all of this is going on. You mentioned Miami as Bitcoin 2022 continues to go on in Miami, the biggest conference of the year for a lot of folks out there in cryptocurrencies. But by the way, Bitcoin and Ether, I want to point those out because they're both fractionally lower in trading. Bitcoin 43,400, Ether 3,200. They are now both below their 200-day average price on a rolling basis, but they are both above their 50-day. So the near-term pullback that we've seen over the last few days has now gotten us to a point where we're kind of in this no man's land trying to figure out where exactly the charts say we could go. So some technicians, some traders checking out those levels there for sure, guys. Joe, back over to you.
You got a lot of rain. Down there. I don't know what that means for hitting into the greens.
It might mean scoring conditions is what it might mean.
I don't like that. I wish it was windy and dry or something. Did you act on your Xander Schauffele prediction? Did you?
I have not. So here's I'm going to make an admission to you, Joe. I am coming around to this idea. I do not have any, full disclosure, any of these daily fantasy or betting type apps on my phone.
You don't have daily fantasies, Dom? I didn't know where you were going with that.
Because
nobody asked you. Nobody asked you.
Exactly. Nobody asked me about those things. But here's what I would say. I fear, Joe, that if I go down that path of putting a FanDuel or a DraftKings or something else on my phone, I will be consumed by it because I really enjoy doing those things.
I can vouch for that. It doesn't happen.
And if I have to use your $5 rule, I could very much get behind that.
I acted on Colin Morikawa. I think I would win $125. I put $5. That made one bet. I think DeChambeau's hurt, right? Or he's not playing well. They're trying to get me to bet on him in the top 10.
So speaking of DeChambeau, one of the things I found interesting was, we talk about this evolution of golf and how Augusta National has done a lot of great things with regard to kind of bringing attention to golf, right? Because they put the Augusta Women's National in the same kind of week-ish around what's happening. The kids drive, chip, and putt. So much focus on golf. I was amazed. Did you watch these Dude Perfect videos of Bryson DeChambeau at Augusta?
No.
You got to Google this. So So no, he goes out with a tennis racket.
The women's. I saw the teenager win last week, which was unbelievable. In the women's amateur down there.
I guess my point is, I would never have thought of Augusta National pairing up with a viral internet sensation like Dude Perfect to make videos, allowing them to do it at Amen Corner and everything else with Bryson DeChambeau. I mean, it's cool. It's a sea change for sure.
Yeah. All right, Dom. Thanks. It's happening. It's Thursday. I'm sorry. Sue me. See you later. Coming up, legendary investor Ron Barron's going to join us. We got plenty of time in an exclusive interview, talking about the recent market volatility, what the Fed's going to do next, and maybe Tesla, maybe Elon Musk might come up. You're watching Squawk Box on CNBC.
Welcome back, everybody. Elon Musk's big move this week, joining the Twitter board of directors, possibly shifting his focus away from Tesla and their shareholders. I don't know if I believe that or not. Anyway, joining us right now is one of Tesla's biggest shareholders, Ron Barron. He is the Barron Capital CEO, a friend of the show. And Ron, it's good to see you.
Me.
So we've been talking about Tesla all week.
Oh, it's great to see you too.
Great to see you too. We've been talking about Tesla and Elon Musk all week, and when it came up with this Twitter, his move into Twitter, obviously your name came up too because you've been a big backer of his. You've been an investor with Elon's company Tesla since 2014.
Yes.
And people immediately thought, okay, would you follow him into this Twitter world? My expectation was no, you would not, because you'd look at the company individually and do your own research on it.
That's right. We wouldn't and we didn't. That doesn't mean he's wrong. I don't think he's investing, the way I read it, $3 billion to make a lot of money on $3 billion. I think he's investing because other car companies, for example, I haven't spoken to them about this, but other car companies spend a couple $1,000s per car that they sell. Elon spends nothing. One of the reasons he spends nothing is that Twitter has been so successful getting everyone to know who he is. So he doesn't have to spend. Everyone knows about electric cars, and everyone's going to know about Starlink satellites without him spending anything. So I think it's important for him to make sure that that Twitter is a viable, strong candidate. You know, they haven't performed so well as a business for a while, and maybe he can help them a little bit.
A viable, strong candidate, and one that won't kick him off the platform. Does that need to be underscored
I don't think anyone's going to kick him off the platform. I mean, do you see what he did with SpaceX and Starlinks in Ukraine? I mean, unbelievable. Yes. They, in 48 hours, were able to provide the Ukraine government with the ability to communicate with their armed forces. Just like that, 48 hours for landing rights. And they have, I guess, 2,100 satellites right now going around the world. Each of them goes 8 or 9 times. They were able to get these satellites turned on over Ukraine in 48 hours. And then they ship thousands of user interfaces, the way you communicate with the satellite, to the government and to the armed forces, and you're unable to stop that communication. So the defense minister of Ukraine thanked SpaceX for the help that they've given to help them survive.
Yeah, it has been pretty incredible to see. It has been incredible to see. Let's talk about what you think about Elon, specifically when it comes to Tesla right now. There have been some people questioning whether he'd take his eye off the ball with Twitter. I think he's got plenty of attention to share it in a lot of different directions. Does it concern you as a Tesla shareholder to see this happen?
I don't think that's part of it at all. I just think this is helping his marketing. And, you know, when you think about the valuation that he has invested in Tesla, or in Starlink and SpaceX, which I think is potentially going to be, in 15, 20 years, be even bigger than Tesla. No, he's no way he's taking his eye off the ball of anything. And everything he does, you know, I was talking to a Tesla executive, I guess about a couple of months ago, and I was saying, so how does he do this? How did he accomplish this? And they told me that it's the same thing. He says, how did you get to be so successful, and how did you achieve what you have? And he said, it's the same thing. You just question everything. There's nothing that's ever good enough. Question everything. You're always saying, how can we do it better? So Intel, their process is to copy everything. So basically, precisely, so they do it, and then they do it a little bit better. Toyota does it, and then they do it a little bit better. Elon just throws things away and does it all over again if he can make something better than it was before, cheaper, faster, higher quality. He did something in Tesla we were down visiting their new factory in Austin, Texas, about just before Thanksgiving.
Right.
And it hadn't been opened yet. So we're going around, the walls aren't even on the outside. This plant is 10 million square feet, 10 million square feet. What that means is that 5 Pentagons fit inside. And I'm asking them, we're walking around, saying, how do you do this? And the guy who's squiring us around is a young man, is this giant guy, I mean, giant. And the first thing I asked him is, how do you get so big? I mean, do they put you in a field? Do they face you to the sun? Do they water you? Do they feed you? How do you do this? And he says, well, and he used to be one of the top guys at Ford in the Ford 150 program. And mechanical engineering, PhD, 41, 42 years, he's a really cool guy. And he's describing the way they've started to do casting. And so casting in the front part of the car, nobody else could do this. Casting in front is a big investment that you have to make, and you have to have expertise. And casting means that he replaced 150 parts with 3 parts, 150 with 3.
Casting, what do you mean?
They cast all he gets off an airplane and he's playing with a Tonka toy. And he says, hey, these guys can cast a Tonka toy. How come I can't cast my car? And so therefore you make every one exactly the same, higher quality, and you do it faster. Everything is higher quality, faster, and
it doesn't require as much labor.
And less labor, yes, cheaper. And so he's always about making things cheaper and making things better and making things faster.
You have been a long-time bull. I didn't realize you have 12.8% of your assets under management in Tesla at this point?
Yeah, because it went up 20 times in the past 2 or 3 years. If you might remember, when I was on initially, and I was describing the investment, I said I thought we would make 20 times our money in this investment. And what do you know? We invested $380 million, and between 2014 and 2016, the average price was then about $40 a share, and we've made about $1 billion, about 20 times so far. So we made about $6 billion so far. We sold about $1 billion worth of stock.
Just because you didn't want it to be an even bigger position in the portfolio?
Yes. Well, what it was is that I was getting widely criticized for having such a large percentage of my assets in 2 of our mutual funds, Barron Partners Fund and Barron Focused Growth Fund, in one stock. And people said, how can you be so crazy? And so I wanted them to think I wasn't crazy. I know I'm crazy. but they didn't want, I want to be responsible to people, and I didn't want people to say, he's lost his mind. And even though I think for Tesla, this is the very beginning of what they're doing. I mean, they just reported numbers a couple of days ago, and they said that they did 310,000 cars in a quarter, in the 3-month period of time, 310,000. General Motors did 24. Not 24,000, 24. And I'm a huge fan of Mary Barra, and I think she will be successful, and they have this cruise inside of it that I think is going to be a very cool business, and we're an investor in Cruise through her private company. But where was I?
Well, just in terms of what will you do next? So you think GM will be successful too? You think this is just the beginning for Tesla, meaning what?
Yeah, so they did 310,000 cars in the quarter, and people said, well, they should have done 317,000 cars in the quarter. And but at the plant in China was closed for 4 or 5 days, and there's supply chain problems in this period of time. And so everyone's focused on this quarter for 310,000 cars. In 4 years, 3 years, they're going to be doing $1 million a quarter, not 310,000. A million cars a quarter. And if you go 10 years, they're going to be doing something like 5 million cars a quarter. So here you are doing 310,000 cars, and people saying a few thousand more, a few thousand less. I'm thinking about in 8 or 10 years, this is 20 million car company.
You expect to still be an investor in 8 to 10 years?
Yes.
Are you selling any more shares?
Periodically, if people say, if it gets crazy big relative to the size of the fund right now, then I would. I own 1 million quarter shares for our firm in the company. I have not sold a single share of that, and I don't expect to.
Okay.
In my lifetime.
In your lifetime, you don't expect?
In my lifetime.
Okay.
And the same thing with SpaceX. So I think we're going to make 3 or 4 or 5 times our money in the next 10 years in Tesla. And I think it's
again from on top of the 20 that you've made.
And in the case of SpaceX, I think over the next 10 years, we're probably going to make 20 or 30 times our money.
When do you think that company goes public?
I think that it's unlikely that SpaceX is going to go public anytime soon, but this Starlink business that they have, I think that could go public in the next 3 years. And that's the business that is ultimately looking, that's this, I was describing to you about Ukraine. I think that's a business that could ultimately is addressing a potential, they call it TAM, total addressable market, of $1 trillion, actually multiple trillions, communications. And so it's for the government, it's for commercial, it's for people who don't have internet. If you want to have more equitable distribution of wealth in the world, you have to have people educated. The way you get educated, you have to have the internet. If you don't have the internet, you can't accomplish that. So this is broadband satellite internet, and it's an unbelievable business. And the reason they can do it and other people can't is that they have no cost for launch. So everyone, I want to talk about this. And so when everyone else has launch costs of $100 million, $200 million, $300 million per rocket, and they use it one time and then it burns up, our guy sends up his rockets, brings it back down, and uses them over and over again. So his cost is a tiny fraction of the cost of a rocket.
Ron, let's talk about the broader markets right now, because this does seem to be like an inflection point for the markets. You've got the Fed talking about how they are going to bring down the balance sheet more quickly than the street was probably anticipating, maybe raise rates more quickly than that, too. You have talked about inflation for a very long time, about the reason that that's why people need to be invested in the markets, because inflation eats away at your money. Is this the right time to be in the markets? The markets are concerned. We have seen some pullbacks, but at the same time, if inflation is high, where else do you go?
I have always thought that investing in businesses, buying stocks in those businesses is the way you protect yourself best against inflation. So inflation, everyone says, it's a big problem right now. And normally it's so let me talk about inflation. So in the last quarterly letter in December, I wrote about inflation. And I gave a chart that showed in my lifetime, at 50 years, the last 50 years that I'm conscious of the world, that inflation has been 4 or 5% a year, not 1 or 2, 4 or 5, and consistently. And what that means is that everything you want to buy doubles in price roughly every 14 years. Doubles in price every 14 years. The stock market, on average, doubles about every 10 or 11 years. So it's faster than inflation. And what we try to do is double our money every 5 or 6 or 7 years by investing in companies, instead of growing at 7 or 8% a year, growing at 15% plus a year. So that's what we do. And when I think about inflation, what I was describing in the letter is that everything is 4 or 5% a year, whether it's a house, whether it's tuition, whether it's wages, whether it's cars, everything, meat, food. And just to give you one example, that one of the things I wrote about in the chart was the price of sirloin. And the sirloin, when I was in law school, 1966, sirloin was 67 cents a pound. And so I look up on Google, and it's now $11 a pound. So now it's a Saturday night, and it's a couple months ago, and there's a blizzard in New York. And Judy says, "You got to get us food." It's a blizzard. Got to get us food. So I walk out, and I go up Madison Avenue. I walk up Madison Avenue, and there's a butcher shop on the left-hand side, and it's a big glass window. And I walk inside, and there's a guy in there behind a glass counter, and I see these incredibly, large, beautiful steaks. And I say, "What is that?" And he says, "Well, that's a sirloin steak." And I said, "Wow, how much is it?" He says, $67 a pound. I said, $67 a pound? What store is this? He says, Lobel's. I said, Lobel's, wow, I couldn't shop here and afford it when I was young. I still can't afford to shop here. It's amazing, $67 a pound. So everything is inflation, and what you have to do is protect yourself against that, and investments in growth companies are the way we do that. This is a good, so I looked, last night before I came on, I looked up, and there was I found notes I had taken for an interview I did in April of 2020. Market's way down, and it was the same thing. It was just, so I felt funny coming on for a while when people are worried about war and worried about inflation, worried about COVID, and interest rates and oil prices. And so I worry about this stuff, but I don't think about that.
None of it changes the way you invest.
No, it's the long term. You just think about the long term, what something's going to become as opposed to what it is. And the way we have outperformed over the long term is because we invest in companies when they are investing in themselves. When they invest in themselves, they penalize current earnings. When they penalize current earnings, as soon as they say, "I'm growing faster," what happens? Stock prices go down. "I'm going to go faster," stock prices fall. Why? Because people know as soon as they say that, then that means that they're going to hurt their earnings in the short term, and you get a chance to buy stock at lower prices than you ordinarily would.
All right, let's talk about one of those companies that you have invested that hasn't done as well this year, and that's, I want to just talk about Shopify. I think if you look at the numbers, year to date, down 51%, down 43% over the one-year period. Is that a situation like that? What do you have? Assets under management there, it's only about 0.5% of your assets under management.
Right, and so those are businesses that are interesting to me. What's interesting is that they enable small businesses to access the internet, and they provide all kinds of services that once you start using them, you can't switch. So ability to switch to someone else isn't possible, and Amazon takes these businesses and then they try to duplicate the same thing and hurt the businesses who are their customers. This company doesn't do that. So, and there's lots of opportunity to provide more services and charge higher prices.
And so you are a believer in this. Have you bought more during the downturn?
No, a little bit, but not very much. You know, it's something, we have a lot of investments that we start and we learn about them and we build our business. When we were buying Tesla, it was 2014 to 2016, and we were buying the stock in that period of time, and it represented at the time less than 2% of our assets. This is 0.5% of assets. Right. And so it's something we're studying and learning about, and but we don't know enough about it yet, but we're working on it. As you can see there, we have $200 million invested for our firm, something like that, out of $50 billion. So it's not a big investment yet, but maybe it will be.
And you make an interesting point that this is something that other critics have been looking at too, the idea of Amazon ripping off its customers, the customers that it puts up, and hurting those businesses. They may help build them at first, but maybe they hurt them down the road. Would that make you not an investor in Amazon, or is it just the price, the share price, that keeps you away?
Well, I haven't invested in Amazon, unfortunately for me. And one of the portfolio managers, or 2 or 3 of the portfolio managers at Barron Capital have, and they've done well with it. It hasn't performed in the past year. But Bezos is a brilliant guy, and he's built amazing businesses. And this is not exactly a mini company, and they're penalized especially this year because they're investing in logistics. And so people said, oh my God, how can they be competitive in logistics against Amazon, which Amazon is a logistics company. Yeah. So it's something to study and look at, and we're not 100% convinced yet, but we're working on it.
I think Andrew has a question as well. Andrew?
Hey, Ron.
Hi, Andrew.
It's great to see you. Wanted to go back just for a second to Elon Musk, but in connection in something to some degree with Jeff Bezos and Amazon. We've been talking all week about Elon Musk's decision to get on the board of Twitter, and the debate that we imagine is going to happen around censorship and free speech, and we've seen what Elon Musk has talked about in that regard. I'm curious, as a shareholder of Tesla and also of SpaceX, how you think the political, or what you think of the political implications of that. And we've compared it to some degree to what happened with Jeff Bezos buying a piece of the Washington Post. He's done remarkable things with the Washington Post, but there has also been, as you know, political and to some degree, you could argue even economic blowback on Amazon. What do you think of that in regard to Tesla? Obviously, the Defense Department taxpayers are a huge customer for SpaceX. You could see political debates emerging around potentially, again, Twitter. It becomes a bit of a bank shot, but I think there are some investors who've been thinking about this issue.
I think it's meaningless.
Because?
It's a tiny investment, $3 billion for a man who's worth $300 billion. He has Tesla, which is worth $1 trillion, on the way to being worth $3 or $4 trillion. There's no way this can be anything meaningful to him. Period. Meaningless.
I appreciate that perspective. The reason I ask it, though, is you could argue for Jeff Bezos, the Washington Post could be meaningless in that it only cost him $250 million on an actual dollar basis. It's meaningless. But when you think of the mind share it took up, for example, in the last presidency, where you had a president effectively that decided to target his company as a result. And by the way, Elon Musk has even made some comments about the Washington Post and therefore Amazon. He targets them in the same way, and therefore whether that could happen in a similar way to Musk's companies.
Look, one of my friends is one of the best traders alive. And he calls me a month ago, and he says, Ron, tell me about where does Elon get his nickel from, for batteries? And how much does he pay for it? And is it spot prices or long-term contracts? And so I give him a little bit of information. I say, but David, you're missing the point. This is a company that's doing 1.2 million or 1.5 million cars this year, and is going to do 20 million cars a year in 10 years. And they're going to have autonomous driving, which Musk thinks is the biggest innovation, value creation that's ever taken place in the world. Be worth over $1 trillion alone, that alone. And they're going to be able to sell, if they sell, 20 million cars at $50,000, that's $1 trillion. They're making 30% profit margins. The industry's making 7 or 8%. The industry has union issues. Well, Biden loves unions, but and I'm fine with people making a lot of money for workers. I'm not fine with the people who are workers saying this is the way I should work and this is the job I should do and this is how I should perform. So I think that when you focus on a issue, it's not relevant to how large a company is going to become. And we want to have electric cars. That's our goal. We want to have alternative energy. Tesla has solar roofs, and batteries, and insurance, and ride share. And there's one thing after another, and you say, oh my God, and this company's valued for $1 trillion now. Why is it not going to be worth, it's certainly $2 trillion, but why is it not going to be worth $3 trillion or $4 trillion or $5 trillion in 10 or 15 years? So when you're focusing on something that's meaningless, and it will never have any impact on anything, and it just takes you away from looking at the big picture. Just like when you're thinking about interest rates, as opposed to thinking about you have to figure out some way to protect yourself against inflation. So these things we don't care about. It's not relevant to me, and people can pick up something, a short seller or a long guy or a hedge fund is going to pick up something that you can trade on. It's not relevant. I don't care.
That's kind of your message for everything, though, missing the forest through the trees.
Yes.
You got to step back as an investor, just in general, in buying stocks and not listen to the noise around you.
Yes.
Yeah. Very quickly, let's talk about Charles Schwab, because this is an investment you've held for quite a bit longer. How long have you held those shares? I think it's 1.2% of assets under management.
Since 1992. So our initial cost in that stock is less than $1 a share, 80 or 90 cents. It's now $80 or $90. In fact, this former CFO of Charles Schwab, Chris Dodds, was on when he left Schwab, knows me since 1992 or since the 1990s, and great basketball player, by the way, great basketball player. And Tulane All-Star American. They had to triple team him when he was playing in college, triple team him. Anyway, so when he left Schwab, he was on our board, on a board of a couple of large private equity firms. And then Chuck asked him to return to be on the board of Schwab. And he had to resign the other board seats and ours too, because there was a conflict. But Chuck said, you can stay on Ron's board, and you can attend his meetings, you just can't vote. And when there's anything that's a conflict with Schwab, you have to leave. But we have a business because of Charles Schwab. It was too hard to buy and sell. We had a $50 million mutual fund in 1992. That's it, $50 million, $100 million under management. And we couldn't make it grow because it's too hard to do business with. We get on a platform that Charles Schwab created, and all of a sudden, our business starts getting in $10,000 a day, $50,000 a day, $100,000 a day. We get recommended, and all of a sudden, our business started to grow. So I said, we better look at this company. And we go visit them. And I'm enamored with him, how he took all this money that he had and invested in technology, gambled the whole company in technology, and built this incredible platform. And Fidelity followed him. Fidelity, another incredible company. Because they revolutionized the way you buy mutual funds. Instead of having to send money to us, you send it to Charles Schwab, and you buy and sell on the telephone, and we pay them to make our funds available.
So you've had it since '92, no plans on selling, I take it?
It's an investment that I have owned over 1 million shares, 1.1 million, 1.2 million, that I bought then when I had very little money, and I've never sold any.
Ron, I want to thank you very much for being with us this morning. It's great to see you in person.
It's great to see you too.
We really appreciate your time.
Thank you very much for inviting me.
Thank you. Andrew, we'll send it over to you.
Thanks, Becky. Great interview. Meantime, let's get a quick check on the markets right now, show you where things stand. The futures ahead of the open, still about 2 hours before it's going to open, but can open down just marginally, about 21 points on the Dow. NASDAQ looking higher, about 40 points higher. The S&P 500 higher as well, a little over 3.5 points. Let's also show you Treasuries. You're looking at the 10-year note right now, 2.607. 2-year, by the way, 2.451. The Fed will be the focus today with a couple of Fed presidents speaking. Still to come, we're going to talk about should Twitter shareholders join Elon Musk on the dance floor or head for the exit. That's the topic of this week's On the Other Hand with John Ford. He's going to join us in just a couple minutes. We're right back after this.
Time now for today's Aflac trivia question. What term was conceptualized by Warren Buffett that describes a distinct advantage a company has over its competitors, which allows it to protect its market share? The answer when CNBC Squawk Box continues. Now the answer to today's Aflac trivia question. What term was conceptualized by Warren Buffett that describes a distinct advantage a company has over its competitors, which allows it to protect its market share? The answer, economic moat.
Sports platform giant Fanatics closing a $1.5 billion funding round in March, bringing the company's private valuation now to $27 billion. Joining us now with more on how they're deploying the capital, Michael Rubin, CEO of Fanatics. This is our latest snapshot, our latest update. Michael, for people that don't remember the last round, how long ago was the last funding round, and what was the valuation at that point? Because it's like, I don't know what kind of returns these are. I need a calculator.
Joe, how you doing? Good to see you. Last round we did, I think it was last summer. It was around $18 billion. And we felt like we were just getting started then. We feel the same way today.
Well, so that's another 50% on top of that. So where was the miscalculation on what your business is worth? It's not really a miscalculation. You're doing a lot of great things, but were the previous valuations just way too low? People didn't understand it. Is this now very rich and something that's going to be hard to grow into? I mean, where's the disconnect on how quickly this is growing? Are you just like the greatest genius of all time, financial genius?
Well, I'm definitely not the greatest genius of all time. That is for sure. I think we all know that. Look,
I don't know.
The company's gone through a pretty fast transformation. We started originally in the consumer products and merchandise business and reinvented that category. And we really transformed the company into a digital sports platform. And we've added several new businesses since. So you think about this, a couple of years ago, we had this fast-growing direct-to-consumer merchandise business, and today we have that, plus we have the collectibles business, the NFT business. We're entering the online sports betting and iGaming business. I think we have our sights on, other digital sports business in the future. So I think we have a pretty enormous opportunity. We aspire to build, one of the biggest technology and sports companies long term. And, ultimately, we want to have billions of sports fans that we serve, throughout the world that look at us as a beloved brand. So I really feel like we're just getting started. One thing I will tell you, when we do our deals, we always look to, one, listen to the market. We had 50% of our investors were new investors in this round, firms like BlackRock, MSD, Fidelity, QIA, and we look to listen to them. We also always look to leave, really room on the table because we want to keep giving investors great value. And I think $27 billion is actually very inexpensive, and we're going to prove that in the future. So we feel great about where we're headed. The company's going to be over $5 billion of revenue this year, highly profitable, and again, just getting started.
So the president just said something to Amazon. Amazon, we're coming for you. And I'm just wondering, could you be a private company in 5 years? Would there be, I don't know if I'd want to be a public company. I'd almost like to stay, if you can keep raising money like this privately, will you eventually go public, or is it possible that you just never pull the trigger on that?
Look, anything's possible, but I think we're going to be a public company. I think it makes sense for us. We have great shareholders that have invested in us. We want liquidity for our employees. I think it does make sense over time. And I think for us, we're doing so much right now as we're adding these new businesses and new verticals into the digital sports platform. I think it makes sense to do it in a private environment, but I do think it makes sense for us to be public, and I think we'll be, an exciting public company. We're looking forward to that in the future.
Timing, why not now? Why? What's the problem? No time like no time like the present.
Yeah, there's no problem at all. I think for us, as we've now entered the collectibles business, entering the online sports betting, iGaming business, entering the NFT business, we like to do that kind of as you're launching new businesses in a private, kind of environment. But again, look, we've been very transparent about it. I think we should be a public company, and I think that happens, in the kind of medium term. It's not long term. It's not tomorrow.
Do you foresee increasing? When you're private, you can do what you want, I think, too. Would you buy more of the 76ers? Would you buy other teams that just almost vanity projects? Or is everything about the bottom line down the road?
Yeah, absolutely not. I've made it clear that my focus is 150% on Fanatics. I've never worked harder. I've never had more fun. I think I start at 4 or 5 o'clock most mornings. I go hard every day. I do it, 7 days a week, and it's 100% focused on how do we build the most incredible digital sports platform? How do we have, as I said, hundreds of millions or even billions of fans that look at us as a beloved brand that they can do all the digital sports needs with? And I think focus is really important. So while I remain involved with the Sixers, there's going to be no future sports ownership for me, because I think that's a distraction from me putting all of my energy into leading Fanatics with our more than 10,000 incredible employees.
Well, I don't know. If you own more of the 76ers, I don't know if the floor seats would get any better. Would you get maybe a couple more? You can't really move them on to the, like under the basket or something. Okay? You can't get much better. You don't need to add to it. You think you got the composition to go all the way this year, just as an aside?
Listen, first of all, for you, we're actually going to get you in the metaverse. We're going to put you in the game. We're going to have you, really participate in the biggest way.
My vertical jump's about 3.5 inches, honest to God.
I'm going to be honest with you. I'm taking under 2 inches, not feet.
For me,
Look, the reality is we have a competitive, good basketball team, but there are several other competitive basketball teams. I think we have a great organization. We have tremendous players, tremendous coach, tremendous organization, great ownership in Josh Harris and Dave Blitzer. But the reality is, I'll tell you when the season's over. You have one job when you own a sports franchise. Championships, and anytime you don't do that, you fall short of the goals for the city that you represent. And I think Sixers remain hopeful, but until it happens, we haven't accomplished anything.
Have you watched the Lakers drama on I don't know what network it's on, but have you watched it? Yeah, HBO. It's hilarious.
It's so funny. It's so good. It's not like other than watching
was
you guys
Jerry
wake
West
up in the morning.
You think Jerry West was really like that, honestly?
Well,
you think Jerry West?
Other than watching, I tell people this all the time. Other than watching you guys in the morning, and for the 10 minutes in the shower, and live sports at the end of games. I do not watch any television. I'm addicted to that show. I just saw Judy Buss in LA a few weeks ago. I was talking to her about it. I've got my daughter who I'm getting to watch it now. My whole family's into it. I've got my baby watching it with me. So it's a great show. I don't know whether it's for that while, but it's amazing. I'm getting great education. For me, I've really only been in the sports business for, depending on how you look at 10 or 20 years, that gives you the good old time history.
Well, you got to wait, you got to Jerry Bussify your own MO, I think. Get it a little bit more like Jerry. You got the gold chain, you got the open shirts and things, and maybe a stash. And a
Listen, my job is to satisfy hundreds of millions of sports fans with everything they want. I'm going to stay focused on that.
They're
That's
yelling
gets
at me
you in trouble.
again. Whenever we have fun, I get yelled at. All right. Thanks, Michael. We'll see you. Squawk Box.
Hey,
be right
thanks
back.
for having me.
All right.
Investors have been reacting this week to the news that billionaire Tesla CEO Elon Musk has bought a 9% stake in Twitter and is joining its board of directors. So is this good news for Twitter shareholders? John Ford is here to weigh in. Good morning, John.
Morning, Becky. I mean, this is my second time in 5 weeks talking Elon Musk here, and on the other hand, didn't intend to, but like Elon himself launching an ill-advised tweet, I just couldn't resist. But yes, this is great for Twitter investors because Elon Musk understands what Twitter is in a way that Twitter itself seems to have forgotten. And the first step in having a healthy, growing product is knowing what it is. Twitter's a platform for real-time expression, a town square. Users need to be able to trust that their voice will be heard and that opinions will be treated fairly without political bias. That trust in Twitter has taken a major hit over the last few years. Now, Elon's voice in the boardroom is going to keep management accountable to the principle of free and fair speech. A more trusted platform will be a more stable platform, and a more stable platform will retain users and advertisers. So having Elon on the board is particularly good for Twitter CEO Parag Agrawal. With Jack Dorsey leaving both the CEO position and the board, Agrawal lacked a high-profile advocate for Twitter's relevance. Now he's got the most high-profile innovator in tech. In this case, Elon Musk is like the best kind of activist Twitter investor, one who uses and understands the product and can rally people to a cause, Becky.
Okay, but Elon attracting a lot of attention. However, is that the kind of attention that Twitter really needs right now?
Well, Becky, on the other hand, Elon joining Twitter is going to be a disaster for the stock and for current management. I mean, Elon isn't an activist investor who uses the product. If he were, it might be good for existing shareholders. No, Elon's an activist user who happens to have invested. He's very adept at using Twitter to boost the prices of Tesla stock, Bitcoin, Dogecoin, but he's shown little interest in Twitter's actual business model. That might be because Elon's personal incentive is in having a platform as open and lax as possible, where he can call people pedo guys or sock puppets or say funding is secured whenever it suits him. Investors should be wary that for Elon, unlike anyone else on the planet, Twitter would be worth more as a money-losing, uncivil libertarian shoutfest than as a profitable, lightly moderated, friendly conversation platform. And this is not good for CEO Parag Agrawal. Twitter culture has a sad history of drama driven by big personalities. And almost as soon as Jack Dorsey left, here's Elon. Mark my words, this is already a mess. Twitter engineers are going to be confused about whose vision is really driving the company. Analysts will look to Musk's Twitter feed to move the stock. And lawmakers will have a new billionaire punchline to hit Twitter with when we have to suffer through the next round of dead-end social media hearings on Capitol Hill, Becky.
Two very effective arguments, John. How will we know which way this is leaning?
Well, I mean, if you look at Elon's Twitter feed this morning, maybe, I think it has to do with whether he's using Twitter to talk about Twitter himself or whether he's using it to boost Twitter management's voice and vision. We'll see.
Yeah.
Right,
I don't think I have much to
when you
guess
do
with
the
that.
second one, I always think, you know, you leave us with the second one, and I didn't like the second one. But I did like when you said, lightly moderated is like what it's. Yeah, that's what it is. That's what Twitter is right now. It's lightly with the soft touch, just the right amount. They need a shake-up, John. I like your first one much better.
Well, you heard what Ron Barron said. It's just free
There you
marketing
go.
for Elon.
Yeah, right, exactly. So do you do the second one as the one you really believe, John, or not?
I try to switch it around,
Okay.
you know, so you
don't
can't
know.
tell.
Flip a coin, flip a coin.
That's the way it should be.
John, thank you. Great to see you. By the way, folks, later we'll have an exclusive interview with Reddit co-founder and venture capitalist Alexis Ohanian on Elon's joining the board of Twitter. Squawk Box will be right back.
Like that.
back to Squawk Box. Take a look at the futures ahead of the open. Still about an hour and a half to go. You're looking at the Dow off just marginally, but the NASDAQ up about 50 points, S&P 500 up about 7 points. I want to talk stocks and the bull case for tech. Carrie Firestone's here, Chairman and CEO of Oris Asset Management, also a CNBC contributor. Good morning to you. You're bullish at a time when it seems like everybody else isn't, Carrie.
Well, bullish selectively. You know, we saw the NASDAQ get crushed, and 2 weeks ago, there was an opportunity to buy a lot of stocks that were down 40 to 80%. And we did some of that. And I think smart investors did the same thing, because despite the fact that we've got problems with interest rates, inflation, supply chains, when you see stocks reflecting absolutely the worst news, and they've come down to levels that you can justify the price with earnings and stability and growth rates that these companies have, you have to make some decisions that are tough at the time, but will pay off in the long term. It's not as if we did that with the entire portfolio.
Let's talk about some of them. Autodesk is one.
Yeah, so Autodesk had a very tough last year. Stock was down over 30%. This is a double-digit grower. I mean, we've been waiting for it to come down to this multiple. It has earnings growth in the high teens to 20%, revenues in the high teens. And with the advance of technology across all platforms, including construction, for example, and design, this is a company that we think has an extremely strong future. And at the valuation that it sits now, again, we think it's attractive.
And then what do you like about Fidelity and American Tower?
Well, Fidelity National, FIS, that stock is selling at 12 times earnings. And people talk about, the payments business, that's a bad business, lots of competition. That's not the majority of their business. They provide a lot of critical services for banking industries and just, merchant transfer, capital allocation. And at the level it was trading, again, if you look at that stock price, it was crushed. And we thought, here's an opportunity. We would take advantage of it. It's a stock we hadn't owned for years, but we bought it again. And the other one you asked about, American Tower. American Tower is in a business that, as you know, is growing and continues as the world becomes, 5G platform for all types of digital and Wi-Fi. We live based on our phones and viewership of screens, and that's what they provide. It's a great company, and it's global now, and there's considerable growth in many geographies that isn't going to abate if there's a recession.
And you're not alone in that view. You can see that stock has actually moved up materially just in the past couple of weeks there. Carrie, thank you. Appreciate it.
Exactly.
It is just after 8 a.m. this morning right here in New York. We're watching Squawk Box. We're live at the NASDAQ market site in Times Square. I'm Andrew Ross Sorkin along with Becky Quick and Joe Kernan. The futures right now looking up on the S&P 500 and the NASDAQ. And now the Dow. The Dow was off in the red just minutes ago. We're now less than 30 minutes away from jobless claims data, expectations there. 200,000 new claims. We're going to bring you the numbers when they cross, of course. Fed also in focus today after the release of the Fed minutes. St. Louis Fed President Jim Bullard, Chicago Fed President Charlie Evans, Atlanta Fed President Raphael Bostic, and New York Fed President John Williams. They are all going to be making public appearances today. So we're going to keep our eyes on what they have to say. And I imagine there'll be a
futures again. Dow's down by 6.5 points.
Cacophony of
news.
Yeah. We're also watching oil prices this morning. They are rising after touching a 3-week low. So here we are. More to come.
Let's get to Dom Ju. He's been taking a look at some of the big movers in the pre-market this morning. Dom, what do you have?
All right, so what we got right now, first of all, earnings season is continuing. It seems to always be going, but this one is perhaps a little bit more indicative of the current environment that we're in. Andrew had mentioned the oil prices rising right now. Well, commodity cost pressures are impacting a lot of different companies, and we've been talking a lot about the food processors. Well, the latest one today is ConAgra. ConAgra shares are off about 3.5%. Now, generally speaking, they came out with earnings that matched estimates. The revenues there were actually better, but the investors out there are focusing on the full year forecast for profits, which ConAgra has now cut, and they cited What else? Rising raw materials costs, those input costs, as well as freight costs and transportation costs that are eating into their margins. So ConAgra sees its full-year profit outlook being lower than it previously was. That's what's driving a lot of that 3% downside to ConAgra today. So a very big food processor in the world taking another step towards telling people about the inflationary pressures and how it impacts them. Also watching what's happening with another commodity cost story in some way, and that is shares of Ford right now, which are down about 1% in trading. The reason why, in large part, is because analysts over at Barclays have now cut Ford from a prior overweight or buy rating down to a neutral or equal rate rating. They also cut the price target to $17 from a prior 23. And what they cited, among other things, was the continuing computer chip shortage, which they feel Ford is more vulnerable to on a relative basis. Also, the commodity cost pressures that go along with it and the suppliers that go along with that supply chain. So Ford shares under a bit of pressure right now because of that Barclays downgrade. And then as we do here, Joe, check in the most popular tickers that are searched by our viewers and listeners and readers on our website, cnbc.com, from yesterday's full session. The 10-year note yield is still at the #1 spot. 2-year note yields are still in the top 10, but the 10-year, 2-year spread has now fallen to number 15 on the list. Congrats to those folks on Twitter who pointed that out. Tesla, Nvidia, Twitter, among some of the single stock transactions and names that are up in the pre-market trade. And WTI crude, to Becky's kind of a point in interest, has now slipped to number 9 on the list. So even though WTI crude is up today, Joe, it is slowly slipping from that number 2, 3, 4 spot down to number 9. We'll see if that trend keeps going.
Yep. The big factory opening, Giga factory
Giggity,
in
giggity.
Austin. Yep. That is Tesla at the top. All right. Thanks, Tom. Coming up, Banking Committee lead Republican Senator Pat Toomey unveiling new legislation aimed at crypto regulation. We'll talk to him for the latest on the proposal. Then later, don't miss our exclusive interview with Reddit co-founder Alexis Ohanian on Elon Musk's move to join Twitter's board. Stay tuned. Squawk Box will be right back.
the war on Ukraine kind of got shelved in terms of his actions and such, potentially cutting off supplies to Western Europe. Gold came off equally as fast.
Well, it's interesting, Ben, and we've seen this in the past. Remember in 2008, during the great financial crisis, when there was a rush to liquidity, gold sold off along with everything else, but ultimately came out of that period of time incredibly strong. Gold's acting, in my opinion, as it should right now. It's a store of value, it's a currency, it's a hedge against uncertainty, but you don't play gold, again, in my view, to create wealth. You play gold and hold gold and silver, for that matter, in order to preserve wealth. And gold has retained its value over thousands of years, while many paper currencies have come and gone. The war on Ukraine has highlighted a couple of really interesting things structurally in the gold market. Over the last several years, we've seen a flow of gold. We've seen sellers in the West. We've seen big accumulation in places like Russia, like China, like India. While many in the West have been chasing NFTs and cryptocurrencies and all of these digital forms of gold in their view, Russia, China, the central banks there, India, have been accumulating gold, as have individuals in those countries.
Yeah, we've been hearing about central banks in terms they've been adding to their gold reserves. Let's talk a little bit about, well, actually, I just want to get back into this chart here to speak to your point in terms of, you mentioned here, we're looking at gold coming off the recent highs up around 2078. That was, again, the beginning of March. But take a look here, gold relative to the 200-day moving average. Again, you spoke to the point in terms of gold being holding these historically high levels and being a good preserver of wealth ultimately. And I like that kind of thought process. And we're seeing that play out here, again, as it holds, well, 1930 right now, but just off recent highs and recent all-time highs up at 2,100 or just shy of. Let's talk a little bit about, I guess the question here is, do you see gold potentially reaching those upper levels or remaining elevated at this point, considering we just heard about more sanctions this week? Putin seems kind of backed into a corner without getting into the political side of things. I mean, still remains for more, it seems like a situation that has consequences, unintended consequences potentially with actions during tense times like these. I mean, even just some of the rhetoric that's going back and forth, forget about some of the military actions that are taking place.
Absolutely, Ben. My opinion is gold is going much, much higher here. And I believe that the setup for gold to go higher was in place well before the war on Ukraine. You've had this incredible amount of fiscal stimulus in the system, an incredible amount of monetary stimulus in the system. You have the devaluing of paper currencies around the world in every country occurring around the clock. The setup was there for gold to go higher. The war on Ukraine has, of course, highlighted gold's role as a hedge against uncertainty. Do you want to own the ruble or do you want to own gold? Do you want to own the greenback or do you want to own gold? I know that $10 paper dollars in my hometown buys a lot less than it did a year ago, whereas gold's purchasing power has remained constant, again, over thousands of years, not just over the short term. I think that what we're going into here is a period where we can see gold move very quickly to the upside, not because solely of the war on Ukraine, but because of the setup that was already in place for the precious metals prior to this tension.
Talk to us, what does this mean for silver, Brian, in terms of gold remaining at relatively elevated levels or extending some of these gains we've seen potentially ultimately provide or support some of the industrial metals, specifically silver?
For sure, Ben. Now, it's very interesting. We come from a perspective within Zacatecas Silver of having recently acquired a large, very high-grade gold oxide project, but our initial bedrock project was a silver asset, and we're drilling on the silver asset around the clock. We're very bullish on silver. We obviously are constructive on gold, or we wouldn't have transacted on this large gold property. It's a very advanced stage property. We'll be moving towards production. But silver, in my opinion, is a real triple threat. You have the monetary value proposition like you do with gold, i.e. silver as a currency, as a proven currency, and a hedge against uncertainty for thousands of years. You also benefit within silver from this rapid infrastructure spend that's going on around the world as part of the various fiscal stimulus programs that have been occurring over the last 24 months. Additionally, you have the benefit within silver of electrification and a move towards decarbonization. Silver is an essential component of electric vehicles. Without silver, there is no Tesla. Silver's a critical component of solar. So silver is really a triple threat: monetary, infrastructure, and electrification / decarbonization. So while we're bullish on gold, I would say that at the moment, even more bullish on silver.
Sounds like it. Let's talk lastly about the dollar's role in all of this. It has been relatively elevated. Oftentimes we talk about this creating a little bit of a headwind for the metals. It seems like at this point it hasn't, though.
That's right. I think that we've seen a flight to perceived safety. We've seen a flight to the dollar, of course, during these times of turmoil throughout the world, during this time of the war on Ukraine. But at the same time, when I look at gold as a currency, I look at it against all of its competitor or imposter paper currencies out there. And inherently, gold is becoming more valuable every day because, as they say, the Fed can't print more gold. And there's more and more greenback. There's more and more paper currency out there. Every second that we're doing this interview, there's no more gold out there in the world today than there was 1,000 years ago. Inherently, versus its peer group of currencies, its competitors, gold is becoming more valuable by the minute.
Brian, appreciate you sharing part of your Thursday morning with us to share your thoughts here this morning on the TD Ameritrade Network. Brian Slurserchuk, the CEO of Zacatecas Silver. It's good to have you back, and we look forward to seeing you here in the future, hopefully. We're going to take a quick break. Stick with us, though. Coming up, Fed Minutes, the move up this week in rates. All of that with Michael Zaremski, the Director of Futures at Charles Schwab, in just 2 minutes more futures after this short break.
Power those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to the Future Show here on the TD Ameritrade Network. Before the break, we were talking top stories that are on the minds of traders and investors as we get set for the cash open, how the indices are kind of treading water after a big sell-off yesterday in reaction to Fed minutes. Let's bring in Michael Zaremski. He's the Director of Futures at Charles Schwab. He's here to help us take a look at the minutes from yesterday, a deep dive into Michael. Good Thursday morning to you. Thanks for joining us. And before we get into the specifics in terms of some of the details they provided, I just wanted to take a look and get your thoughts on market reaction to a sharp sell-off. And, well, I just pointed out this morning, while we did see some weakness yesterday, we haven't really extended those losses in the overnight session.
Good morning, Ben. Yes, after really kind of a volatile move there in the market there after the Fed minutes were released. In fact, you looked at those couple of bars right after that, you see a huge amount of volatility both to the up and downside there. But overall, generally, the market did once again sell off as they really confirmed what I think really everybody seemed to know, though, as well, too. The Fed was going to be more aggressive in their tightening policy going forward there as well, too. And the minutes really just kind of confirmed what we're hearing from the Fed speakers here the last several days as well, too, that they were looking for, you know, getting ready to roll off the balance sheet there at a much more aggressive pace there as well, too. And the probability of bigger increases in rate hikes there in the coming meetings there is definitely on the table here. But right now, the market here is kind of taking a little bit of a pause here. I mean, we did have really a correction here from that, you know, steep rally we had here off the February lows here as well, too. So a little bit of a pullback was probably expected here as well, too. And right now, as far as the S&Ps goes here, we're really at kind of I think a pretty key support level here, right around that 44.50 level in the June futures there, which is also right near the 200-day and 20-day moving averages here. So this is really kind of a key point. If you are a little bit bullish here on the market here, I think you really want to see those 44.50 lows hold here to end the week.
I'd agree. Ultimately, if we were to see continued weakness, we have the lows down around 4,100 for those that have their sights set significantly lower. And while quite a ways off, that does seem to be at a bit of an extreme to keep an eye on to the downside if this were to build some momentum. Michael, some details yesterday in terms of the taper ultimately, and it also sounds like that drumbeat that we've been talking about, how it's grown louder for 50 basis points, was a topic of conversation at the last meeting that got pushed back a little bit, though, based on some of the uncertainty tied to Ukraine.
Exactly right, Ben. I think that is the part that I think really caught maybe some traders by surprise there as well, too, that the Fed really was ready for coming right out of the gates at 50 basis point. Right. It wasn't, except for the Ukraine situation, they decided to be a little more cautious there as well, too. But I think that caution is now out the window here as well, too, especially given the good employment data we've had here as well, too. And if we get higher, you know, inflation data coming in next week there with the CPI and PPI as well, too. Yes, I think there's really nothing standing in the way from 50 basis point increase, at least for the May meeting and possibly the June meeting as well, too. And going forward there, then I think the Fed is really going to be more data dependent there to see, okay, how is the economy faring after these hikes as well? Do we start to see a bit of slowdown here? Do we start to see inflationary pressures start to pull back? And if we start to do that, then maybe, you know, 25 basis point increases going forward there can be on the cards here. But if we don't see the inflationary pressure slowing as well, too, we may see additional 50 basis point increases going forward. And of course, they now announced the, you know, the targets there for balance sheet roll off, you know, staging it up to 95 billion per month roll off, for about 60 billion in treasuries, 35 billion in mortgage-backed securities. But they also mentioned the fact that they may eventually have to look at selling outright some of those mortgage-backed securities there, but that won't come until the more distant future as well, too. But yeah, overall, generally hawkish figures there as well, too. But I think Leo Brainerd really kind of laid that out for traders and investors there the day before that as well, too, with her statements. And I don't think that it was a coincidence there that Brainerd there was the one that really kind of generate that hawkish rhetoric there as well too, because she is known as more of a dovish Fed official there as well too. So I think that took a little bit more weight, that if one of the dovish members there is that aggressive here, that has really more of the consensus there for the entire Fed.
A reflection of that shift we're looking at right now, the micro 10-year futures contract. So the /10Y, this is a tradable contract, direct access to yields. You don't have to go through the futures product. And I think this is a bit more approachable to some of our viewers and many traders in general, Michael. Now, and I also think this is a pretty good reflection of what we've seen in terms of what's been weighing on sentiment. While Ukraine has been a factor to consider, and it has brought about some intraday volatility, rates really since the beginning of the year, and this more hawkish tone and this really abrupt shift that we've seen is what has them on the move higher, and ultimately is what's kind of derailed some of that momentum we had seen into the beginning of the year in terms of the ES up to 4,800.
Absolutely right, Ben. I mean, look at the 10-year yield here. I mean, we're at levels there we didn't see since the early part of 2019, above that 2.6% on the 10-year. And you're right, Ben, this micro 10-year yield futures is really perfect here, especially for the retail trader who really is looking at, what are the yields? Do they think yields are going to go up or going to go down there? It's a very easy way to kind of play that direction. You don't have to think about the inverse there, bonds versus yields there as well. You're playing strictly the yield there. And it's at a very reasonable, tick value as well, too. It trades in 1/10 of a basis point, which equals $1. So it's definitely something there that's really, like I said, geared to the retail trader there at a very reasonable size and margin requirement.
Yeah, a very clean kind of approach to voicing your opinion, and again, a lot more easily approachable than some of the futures products. Again, the ZN, for example, the bonds, the 10-year, the 5-year, the 2-year. That are also available as well. Michael, you mentioned data dependent and the Fed. I guess this sort of shifts our attention in some ways to the CPI numbers coming out, the inflation PPI for that matter next week.
Absolutely right. Those are the ones that are really going to be the focus on next week, which is really going to be a very busy week for economic data as well, too. In addition to the inflationary figures there, we got retail sales there. And of course, we also have the start of the first quarter earnings as well, too. So we'll see JP Morgan and some of the banks there start to report their later in the week as well. So, but like I said yesterday, Ben, on the show here as well, too, if we see those inflationary figures, especially the CPI, go way over expectations, well above 8% there as well, too, that really does open the Fed up to maybe even another shot across the bow there, maybe a 25 basis point hike before the May meeting as well, too. So definitely don't take that as a zero probability event there if we have a really hot number there as well, too. But like I said, they're going to be data dependent there. They're going to look at those inflationary pressures. Are we starting to see a peak in these numbers here? Because, I mean, let's face it, Ben, look at oil prices there. They are actually down from those peaks we've seen just several weeks ago as well, too. We're seeing the metal prices actually down from the peaks. So really the sections we haven't seen that come down yet are really in the food prices as well, too. They still remain elevated as well, too. But we start to see those figures start to come down as well, too. Then, maybe we have kind of hit peak inflationary pressures. Then it's just a matter of how quickly do they start to run down there. That will depend on how aggressive the Fed needs to be going forward.
All right, put your spring break plans on hold, it sounds like, because, it kind of reminds me of the old Fed watch days. You didn't want to take a break on the trading floor because you didn't want to miss some sort of a Fed announcement. A good reminder that they're not bound to the actual May meeting. Ultimately, something could come sooner than that. Michael, let's provide some takeaways here. Potentially what we saw was a bear market rally as we took out the Fed highs to begin the month of April, end of March. Ultimately, we have seen a little bit of slowdown in terms of some of that momentum to the upside as sense of realism has kind of come back into play, and some of those concerns that have been weighing on investor sentiment since the beginning of the year really were apparent yesterday from the Fed comments and the minutes in terms of what they revealed.
Absolutely right there. Now that the Fed minutes have come out there, we got kind of, I think, guidance about how the Fed intends to react going forward there. Look at the data that comes out going forward, especially next week. Like I said, CPI and PPI, if those numbers come out strong as well, too, I think that could send yields moving higher as well, too. And I think that'll be bad news for the equity markets there, especially the tech-heavy NASDAQ and some of the small caps as well, too. We are at some kind of a key support level here for the S&Ps here near term. If that 4450 can't hold, we see a little bit of more support around 4410. But below that, there really isn't much technically there till we start to look for those numbers below 4,300 here. So I think here the market's maybe going to take a little bit of a pause here. We don't really have much in the way of economic data out of importance this week. Jobless claims here, but those numbers have been steady as well too. But I think the market's just going to kind of take a pause here for wait for a lot of economic data and earnings out next week.
Okay, we were just showing the dollar. It doesn't look like it's pausing very much as it's been breaking out this week. We'll continue to watch the indices, the levels you brought to our attention there, as well as the fundamentals here at play and what's on the minds of investors and traders as we head into the end of the week. Michael, appreciate you joining us. Thanks for taking part of your Thursday to be with us, and we'll look forward to seeing you back here next week. Michael Zaremski, the Director of Futures at Charles Schwab. Coming up, we've got jobless claims, eco data with Dan Deming, the Managing Director at KCAM Financial, joins us to take a look at the numbers, market reaction too, and talk rates, currencies, and lots more futures. In just 2 minutes, stick around. We'll be back.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to the second half of the Future Show. We're less than 60 minutes away from the cash open for stocks on Wall Street. And well, let's check in on where things stand with the four majors, the ES, the NASDAQ, the Dow, the Russell. They're actually coming off a little bit here. And now, well, as you can see, teetering, though, around unchanged territory still, I guess, is the best way of putting it. 44.75 for the ES. You've got the Dow hanging out at 34,355. The NASDAQ, 14,517. And take a look at the Russell, still holding up above that key psychological level 2,000 there. So kind of mixed activity as we teeter around unchanged territory. But let's check in on some of the other top traded products. The dollar, and well, here you can see it's holding upper levels here. Again, it's been strong this week, up around 99.57. Now fractionally lower this morning, but gold's comfortable at 19.30. Crude's below 98, and the VIX here currently at 23.65. There you can see Bitcoin holding 43,760. All right, we just had jobless claims hit the wire, and a very strong number, to say the least. Let's bring in Dan Deming, the Managing Director at KCAM Financial. He's joining us to take a look at the weekly release. Dan, I'm looking at, first of all, welcome, and thanks for sharing your Thursday with us, part of it. Dan, I'm looking at the numbers here. Prior got revised down from 202,000 to 171,000, and actual came in at 166, well below the estimates for 200. This is a very strong number.
Yeah, it sure is. We continue to see consistent weekly numbers below 200,000, Ben. So that's definitely back to the levels that were some of the best levels in the pre-pandemic type of scenario. So, yeah, that the jobs market continues to improve and remain very strong as workers continue to flow back into the workforce. Probably not at the pace that the Fed had hoped, but nonetheless, with the workers that are in the workforce, as far as the opportunities and the lack of, I guess, of workers that are currently kind of hitting the system, as far as the demand appears to be more so than what's available right now when you see all the help wanted signs and the things that they're doing to get people back into the stores and whatnot. That's the that's why the Fed's being more aggressive. It's giving them the opportunity to be more aggressive because that mandate is firmly being met, and now they're battling the price stability mandate.
Speaking of, it does seem like some of this recent job surge has come as some of the mask mandates, for example, have been lifted. I mean, there were some restrictions or some constraints that were holding people back. It wasn't just it's clear-cut situation, and we had talked about that multiple times. I guess I'm wondering, as you mention all of that, I'm kind of wondering, does this take away some of the wage pressure right now, as we have seen, again, workers coming back? Part of that was that wages were on the rise, kind of luring them back in. Does the fact that we've seen that kind of produce or results from that ultimately ease some of those wage pressures that, raise concerns?
Possibly, Ben. Yeah, ideally, yes. But the one thing that I think that might be a challenge, at least initially here, is even with the wage increases that have been, identified over the last, let's say, 6 months to a year, inflation is running much higher than that. So real wages are still definitely below where they were even a year ago, given the fact that inflation is running as hot as it is. So, that in theory would keep pressure on wages as far as, the cost of living type of environment when workers are looking to identify positions that, they feel that might help them combat some of the inflationary pressures right now. But longer term, yes, it should. As more and more workers come into the workforce, there's more availability. There shouldn't be quite the incentives that have been offered to this point. And as you and Michael just pointed out, the Fed is now firmly in the camp of battling inflation. And, it'll be a question of just how long that takes. And the market's reset significantly here in the last couple of weeks as far as interest rate expectations. I think it's being discussed heavily just on Main Street now, in the sense that you're seeing the headlines that are influencing consumers, and we are seeing the consumer starting to lose confidence to some degree. So, those things are starting to show signs of slowing, or at least plateauing, and then possibly slowing over the next several months. And that's what the Fed's trying to do here. So, we'll see how it plays out. If they put the brakes on too hard, then then the market is to some degree pricing in the high probability of a recession, but not in the near term. More so looking 2 years out.
Dan, I guess I asked because wage components a major factor in terms of the inflation that the Fed, again, years ago, or most recently pre-pandemic, was kind of wishing for and hoping for. Ultimately, obviously, these supply chain constraints, kind of the 1-2 punch in many ways, and in terms of inflation. But, it does seem like it's been able to get people back into the jobs. And I guess the question is here, will they need to provide further incentives and further raises or pay increases to kind of keep them in these jobs with a very tight labor market, which still exists? Kind of moving on from that point, in terms of that, hitting the brakes, I guess, is the real question here, because there's a lot of debate now about a soft landing and the Fed's ability to do so. Where do you stand on this?
Well, I think that's going to be a challenge, Ben, just because of the velocity of what we've had to encounter the last couple of years, as far as the slamming the brakes on in spring of 2020, and then kind of being in no man's land for a better part of a year, while various entities tried to sort out how to get us through that scenario. And now that we're coming out the other side, we're seeing rapid acceleration, with no inflation a year ago, at least headline inflation. Now we're realizing that, and you throw in the issues with the supply chain were already bad, and now the war has exacerbated that. So I think it's going to be a real challenge, and the market's demonstrating that in the volatility that you're seeing, not only in the equity markets, but what you're seeing in the commodity markets as well. So I would say, Ben, that we're in for a bumpy ride probably for most of this year, just due to the fact that there's a lot of guesswork right now as far as where we're going to have to get to from an interest rate environment, from a liquidity type of decreasing liquidity measures and things of that nature to drain some money out of the system, to cool things off. And that's there's a lot of guesswork that's going to be involved in that process.
We were just looking at the daily time frame as the TNX works its way up and through 2.5 to 2.6% this week. I was just trying to remind our viewers, and this is a great chart to do so, that still rates are at historically low levels. I mean, again, we are tightening, and we're seeing the Fed become a lot less accommodative, and that's got investors a bit concerned here. But talk to us in terms of what we're seeing now as far as the dollar and some of the foreign currencies. The yen continues lower, Dan. The dollar's getting a little bit of a lift here, but it does seem like the euro hasn't really been the catalyst behind that, as it's yet to break out and post new lows last I looked.
Right. No, you're right. You look at the yen, looking at multi-year lows and just scraping off the recent lows that we experienced. The euro, very similar, Ben. Really, where you're seeing some moderation or some pressure on the dollar is really coming from the net exporters. When you look at the Australian dollar, I know it's not a huge component in the dollar index, but nonetheless, you're still seeing some of those currencies from the Canadian dollar is hanging in there pretty well because of the fact that they have the oil component of having the ability to export oil. New Zealand dollar. So you are seeing pockets of FX strength or currency strength, but overall the general trends continue to favor the dollar short term. Ideally, you got three things involved here that I can think of, and number one, the flight to safety continues to be a theme. You've got interest rates really ratcheting up here in the United States, so that's another factor, and just from just the general trends as far as some of the other trends that we're seeing from a global perspective, where you're seeing China putting the restrictions and things of that nature are also benefiting the dollar. So there's several factors that short term are benefiting the dollar. But I think that as these other central banks start to probably pivot as well, that there will be a time that we'll see the dollar. We're at the top end of the range. We haven't exploded above it. And now we're actually falling back into another range here in this mid 99 level. So, I think that it would be a challenge for the dollar to see too much more out of here, as I think the interest rate environment has reset for a much more hawkish Fed.
Well, that makes sense. Again, expectations that the ECB ultimately is going to have to shift gears and become a bit more hawkish as well, which support the currency in theory weigh on the U.S. dollar. Maybe that's why the euro hasn't taken out those lows as of yet. Dan, thanks for joining us here to take a look at this number, another really strong weekly jobless claims number, and to talk rates and recent developments in financial markets. Dan Deming, the managing director at KKM Financial. We're going to take a quick break. Stick with us. When we come back, my chart of the day, we've got our eye on grains as we head into the WASDE report tomorrow. Again, in terms of a week that was light as far as economic data, sticking with the trend that we've been seeing, a very busy one nonetheless here. We've got lots more futures. Stick around. When we come back, more after this short break.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the Watchlist at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
I'm Jenny Horn. Here's a few of this morning's movers to keep on your radar. Levi Strauss is higher pre-market after beating estimates by 4 cents a share with an adjusted quarterly profit of 46 cents. The jean maker's sales also beat forecasts and highlighted it saw strong demand for its jeans, tops, and jackets while successfully raising prices and cutting down on its promotional offerings. Conagra Brands is falling after issuing weaker than expected guidance for its fiscal year ending in May. The packaged foods company said its third quarter revenue increased over 5% from a year ago, which beat analyst expectations, while adjusted profit came in line with forecasts. Conagra now expects organic net revenue growth to be around 7% next quarter. And Rite Aid is tumbling to 52-week lows this morning after Deutsche Bank downgraded the drugstore chain to sell from hold. Deutsche Bank said COVID has hastened the decline of the retail pharmacy segment, and there's a possibility that Rite Aid may not be able to generate enough earnings to continue as an operating company. This has been your TD Ameritrade Network Market Update. Now back to futures with Ben Lichtenstein.
Thank you, Jenny, and welcome back to the Future Show here on the TD Ameritrade Network. It's time for my chart of the day as we head into the end of the week. I think you should be keeping an eye on the WASDE report. We've got grains on our radar. They've been feeding into the inflation concerns, the unease that investors have been expressing in terms of not only prices at the pump as energy prices have been on the rise, but also at the checkout lane as grocery prices and while some of the grain markets have been and also have been, again, elevated. Take a look here, first and foremost, at corn. Now, after a recent run-up, you can see how we've been very much sideways. We've got a well-defined upper and lower extreme at this point. We'll call it 770 to the upside, 713 to the downside, and you can see how we're just kind of comfortably in a bit of a chop trade, very limited in terms of really well-defined directional conviction one way or the other. So, again, we talk about this overlapping, rotational type price activity as far as, again, what to look for. And this is what we want to avoid, right? We don't want to necessarily be caught up in the chop and, again, dealing with the, enthusiasm tied to the market running up as you're long, and then it comes off and you're kind of stressed out a bit, and then again the roller coaster ride, the emotional roller coaster ride. So we want to try and avoid that, move away from the intraday time frame, take a step back basically. And well, when you do that, you can see corn on a bigger picture has been rallying and trending to the upside, a pretty well-defined trend for that matter. If you're going back a couple years to the lower extremes, we saw down around the $3 level, and well, again, recently doubling plus up to almost $8. You can see now, take a look at the 50-day moving average, how we've been holding above that. You can see pretty well defined, again, trend environment to the upside. We oftentimes talk about these two phases of development, right? And what I like that I'm seeing here in terms of this most recent move up, and basically this is exactly what gold was unable to do. Remember, gold kind of rallied up into the highs that we had seen back in August of 2020, I think it was, and then ultimately, again, failed, and it was unable to take out those highs. But look at how corn did get above the key levels there. Again, we're talking about those highs from May of 2021, and not only get above them, but this is what we talk about oftentimes, acceptance of a new upper level, right? No rejection, simply put. So again, I do want to point out here that corn continues to hold upper levels, bid levels. Now, tomorrow we could see some volatility, potentially the catalyst we need to break us out of this range. I do want to point out, when you're talking about inflation concerns, well, it's not just corn. Let's take a look across the board here. You can see we've got beans, which have been holding at, or in this case, on that 50-day moving average, and a very similar pattern here when you're talking about wheat in terms of these products. Again, across the board here, grain markets have been, they continue to be rallying, and well, not only rallying, but trending higher, holding above the 50-day moving average, feeding directly into some of those inflation concerns, those fears that investors have been expressing. And then, you know, another look at that here in terms of taking a look at what this means and the direct result here ultimately that's had on markets. Well, let's do this. Take a look at rates here. You can see again on the top half of the screen. This has been a major focal point, and it is, again, equated to and directly result of what we've seen in terms of not only, as I mentioned, grain prices, but also energy prices and, hey, commodities in general. We've been talking about cotton, for example, and coffee prices, for example, across the board. They've been elevated, and ultimately this is what's feeding into some of those Fed fears, investors' uncertainties in terms of what's to come, and, well, with commodity prices continuing to hold these upper levels, as we just looked at, wheat and corn and beans, again, really no relief as of yet. Well, you can see how rates have remained at elevated levels also. The bottom half of the screen here, though, ladies and gentlemen, is the, well, ES. You can see how we've come off that all-time high up around 48.08 and, well, have really struggled again to regain composure and take out anything significant with follow-through. We talked about how, well, actually, let's just zoom in on this. We talked about how, again, the ES was able to take out the Feb highs in the month of March last month, but look at how we're right back down below them. Now, what concerns me in terms of this is we oftentimes talk about these areas of balance, these consolidation areas, and as we've started to see a couple lower highs coming into play now, well, potentially a double top here, I do want to point out here that if we get continued weakness through 4,400, through 4,300, well, we oftentimes talk about it opening up a door for a retest of 4,200. All right, let's bring in the host of, well, I should say the co-host of Fast Market here on the TD Ameritrade Network. Kevin Hinks is joining us. Kevin, good morning to you. It's Thursday. A lot of focus here on the Fed rates. I just took a look at the indices, the TNX, the TYX, but I wanted you to help us get ahead of the WASDE report tomorrow. We oftentimes talk about some of the volatility that comes into play in reaction to the release. Grains holding near highs. I pointed out the corn in a bit of a range, but a well-defined upper and lower extreme to keep an eye on at this point. Oftentimes we do see, again, as mentioned, that intraday volatility. What are you watching in terms of these markets as we get set for the cash open today and then ultimately for the WASDE report tomorrow?
Good morning, Ben Lichtenstein. Yeah, we've been spending time on Lael Brainerd and FOMC minutes. That is so Tuesday and Wednesday, Ben. We are moving on to Thursday and moving on to the WASDE report. And, Ben, if you put up a 20-year chart, not a 1 month, not a 1 year, not a 3 year, a 20-year chart of corn futures, you will see the rarefied air that we find ourselves in right now in the price of corn. And so therefore, we're in April, Ben, and April leads to May, and May is when corn and soybeans start to be planted in American towns in the Midwest and across this country. So it's planting season coming up here very soon, Ben. So the quality of that, you have to go back all the way to the drought of 2012, Ben, to find prices that we find ourselves in right now. Now, does that mean futures are going down anytime soon? I don't know that. And news out of Russia and Ukraine will decide that, as there's been major disruptions, as you know. But that being said, Ben, you can still put on a trade playing for some drawback or some reversal in corn futures that is a small to medium amount of risk, Ben. So the trade I did for today, I went out, as you know, Ben, 43 days to June expiration in corn options. And what I did, Ben, I put on the 720, 670 put vertical. And that was trading right around $14. It's trading a little higher than that right now. But, Ben, a one lot there has about $700 in risk, with the opportunity, if corn were to head lower and go towards the 670 level, has the chance to make about $1,800 in profit, Ben. The risk on this trade is the debit that you paid. It's risk defined. It is, like I said, the risk is only what you paid for. You have no risk besides that. So this is a low to medium risk way to play a reversal in the corn markets that could start to come tomorrow, Ben. It also could, it may take longer, maybe longer to be required here. But We are just getting to the beginning, Ben. Just the first chapter of the U.S. corn and soybean season is just about to begin, Ben. So things are going to get a little bumpy, a little interesting, Ben.
Let's take a look at those levels here. I like that, Kevin. I've got a chart here, and I've identified the 720 level on the daily time frame, and it coincides with the lower extreme as I brought you in. This was my chart of the day. We were talking about this range that we're in. The 670 level, significantly below, but you can see it coincides with, again, that support that we found after a sharp move lower, if you remember, at the end of February, as we saw, again, the 25th, it looks like a big day lower, but it was short-lived. We rallied sharply back with high conviction to the upside and into that 780 high. So I see the levels you've got your eye on. Kevin, you know, if we were to see some momentum to the upside and continuation of this trend environment, the pattern that we've seen and breakout here, ultimately, I mean, as you mentioned those points and those levels, I'm thinking how this would just kind of add and feed into some of those Fed concerns about inflation and really investors' unease as we talk about, again, the impact this has all had on us, not only, again, with energies at the pump, but as I mentioned here at the checkout line as well. I mean, we've all experienced grocery prices are on the rise.
That's right. I mean, inflation is one of the, I mean, I believe the Fed minutes yesterday really spelled out how important the fight against inflation is. Now, I don't believe that putting the U.S. economy into a recession is the right way to fight inflation. Yeah. But there's ways that I think the Fed is targeting to do it. Modest interest rate increases over time, hoping that the second half of this year will ease some of the prices as maybe crude oil comes down, maybe new and used auto prices come down with some semiconductor chips. I think if this administration, this country focused on crude oil and semiconductor chips getting into cars, a lot of their problems with inflation would start to dissipate. And a harsh move in interest rates may not be as important if they started to attack those. But right now, Ben, all these things, food prices, right? I mean, Ukraine is about to, you know, they're a big grain producer, mostly in wheat, but they've got some others. Disruptions there are going to cause uncertainty in the grain markets. That's what you're seeing right now, Ben. The question is, when does peak uncertainty stop, and when does a slight amount of less uncertainty start entering these markets? Doesn't seem like it's yet, Ben.
I like that, Kevin. We always talk about futures markets being forward focused. Peak uncertainty will come in at some point. We will see prices come off upper levels. It's a matter of when, not so much if. Now, we just looked at the TNX real quick. If I just pull one more chart, because I wanted to point out here, as you look at now the TNX on the right, which has again been elevated, trending higher, corn on the left, you can see how these two are directly tied, again, in terms of those recent run-ups we've seen off the spring 2020 lows. Kevin will check you out throughout the day here on the TD Ameritrade Network. Kevin's the co-host of Fast Market. That's it for us here for Futures. Stick around, lots to come. Caroline Woods filling in for Oliver Rennick. Morning Trade Live's headed your way next.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on thinkorswim for the full options for volatility course and a whole lot more.
thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience thinkorswim by TD Ameritrade, there's no going back.
Good morning and welcome to Morning Trade Live. It's Thursday, April 7th. I'm Caroline Woods filling in for Oliver Rennick. We have a lot to get to today, so let's get started with what's coming up in the first hour of the show. We'll get some reaction from today's jobless claims numbers. We'll dive into small cap stocks and potential opportunities in the space. Movers this morning include HPQ, which is rallying following a large investment from Berkshire Hathaway. And we'll go inside out on some potential ways to protect yourself from inflation and a recession. Now let's check out what the futures markets are doing this morning. Seeing some red arrows, although futures are pretty flat this morning, looking like NASDAQ only down about 0.2% right now. Dow could open about 0.3% lower, S&P even lower than that, and Russell almost flat. So seeing some red, but looks like it could be a pretty sluggish start to trading. We'll see if that picks up to the upside or the downside. But let's first kick things off with Kevin Hanks, the co-host of Fast Market. Kevin, I understand you're joining us from the phone today, so at least we can see your picture. Want to ask you about the jobless claims number this morning. Pretty good.
Good morning, Caroline. Yeah, almost a historic jobless claims number, first-time filers for unemployment insurance. After last week's low number of 202,000, that number revised down to 171,000, and this number comes in 166,000. Caroline, to say these are numbers that are indicative of a strong labor market doesn't do justice to how low these numbers are and how strong this labor market is right now. So, you know, we've been talking, Caroline, as you know, for months about job openings and migration from the sidelines into the labor market. And we've been waiting and frustrated by the numbers. Well, it looks like you're getting a big migration now from the sidelines and those people that were staying at home and staying out of the labor force now into the labor force. Now, how does that move the overall market? Well, coming off Lael Brainerd on Monday and the Fed minutes yesterday, they were as expected, right? Big, volatile moves to the market. So now we've got a relatively calm stock market to start the day here. And, you know, be careful here. Traders should understand that the 10-year note and the corresponding 10-year yield, in terms of relative strength, the 10-year notes are extremely oversold here. The 10-year yield on the upside, currently trading 2.62%, is extremely overbought. So what I'm looking for there, and which would be favorable to this market, if the 10-year yield and bonds and notes started to consolidate here and take a breather. If we start to look away from bonds and interest rates and start to look towards the extremely healthy U.S. economy, that could cause some less tensions in the overall market, Caroline. You've got some good news. Remember, there's really no more economic data this week, Caroline, so you could have a little space here where the market could see these good numbers and use those going forward. Right now, to start the day, you've got very low percentage moves here in the four major indices, Caroline.
So, Kev, you said the very healthy labor market, you know, clearly based on jobless claims, but also the March jobs report that we saw, the labor market is strong, yet we're hearing more and more recession forecasts. So these are kind of mixed signals. What do we believe?
Well, true, you know, right? Some people are taking the yield curve and the impending rise in interest rates, and they're immediately connecting the dots to a recession, right? That is the knee-jerk reaction to an inverted yield curve or a flattening yield curve and interest rate hikes going forward and the aggressive tone that the Fed has. Now, the mistake that people could be making is, and I'm not guaranteeing this, but you have to make sure, look at the 10-year yield and look at the number of Fed rate hikes that are already in the market. And that may be where you get some firming or some tradable markets. So, yeah, you're right. A lot of people taking the general economic data, which is, you know, and the signals that they give, like a flattening yield curve, like an aggressive Fed fighting inflation, and connecting the dots to a recession. We'll see if that plays out, Caroline.
In terms of what else to watch for, you said this is really the only data we had left this week. Of course, next week we have some key inflation reports. We have more reads on the consumer, which will be important. But investors sort of searching for direction today after falling for 2 days on basically a more aggressive Fed. What do you think it is that's going to give this market direction, either to the upside or to the downside, Kev?
Well, here's the good news is we're now about a week away from first quarter earnings season. And so that and the corresponding conference calls and guidance that will come from that will give the American trader or you know, the U.S. markets a real good picture of how these CEOs see this economy going forward. You know, once earnings season starts, it doesn't come with a drip, Caroline. As you know, it comes like a fire hose being turned on with earnings. So we're going to get a bunch of information, not only from inflation and normal economic data, but corporate earnings as well coming up very soon here, starting with the financials next week.
Which companies are poised to perform best or weather the storm best when it comes to the upcoming earnings season? I know we already started to see some revised guidance.
Right. And, you know, it's going to be interesting, right? Because so many of these sectors have been beat up. Now, the obvious one is sectors that should be doing better are financials, right? Because interest rates going up adds to the net interest margin at these firms, and that should be a windfall for some of these financial companies. Now, real estate might get hurt. Utilities might get hurt. They're very sensitive to interest rates. But right now, it could be things like banks and financials would be the number one focus for a rising interest rate environment because of lending, right? But you also need, banks also would benefit in financials from a yield curve that is steepening, not flattening. So that takes away some of the energy from rising yields. So banks start us off. That'll be very important. Remember, you've got Amazon and Google Google Alphabet coming up with stock splits in the near future. That'll be interesting. So, yeah, there's plenty to look at. But starting off, Caroline, with financials.
All right, we'll leave it there. Kev, thanks so much for your insights. We'll see you later on Fast Market.
Have a great day, Caroline.
You too. Now let's welcome in the host of Futures here on the TD Ameritrade Network, Ben Lichtenstein. Good morning, Ben. Kev already kind of started talking about rates, but you can continue that conversation. He says he's looking for some consolidation. What are you looking for after the run-up we saw yesterday?
Well, Caroline, good morning. I don't think we're seeing any indication of consolidation at this point. In fact, as I look, the bonds are posting or at new low prints as we speak. So the futures, again, are where I'd like to start, I think, is the best place in terms of, and the longer end, the ZB contract, the 60-minute time frame really says it all. You can see the trend environment we've been seeing, and this just goes back to the beginning of March, basically, from 156 all the way down to, as I mentioned, just posted a new low as we speak, Caroline. So no rejection. And in fact, this market's actually trying to push lower and break out again out of a bit of an area of consolidation that we've been in as we awaited the Fed. We got some news yesterday. Again, the Fed pretty clear in terms of, well, revealing plans that they're going to cut the balance sheet by more than $1 trillion in a year. They showed, well, that there's been this desire to clamp down on inflation. The March meeting, there were officials that actually were in favor of a 50 basis point rate hike, but they held back in terms of the situation, ongoing developing situation in terms of the Ukraine. Look at the bonds here again, which continue lower. Also, the 10-year, which has been trending lower. So we're talking futures, and we'll look at rates in just a second. You and Kevin were talking about yields, but I want to point out this has been what's at the root of the selling we've seen basically since the beginning of the year. And you could go back till the beginning or middle of November when the NASDAQ topped out and posted all-time highs last fall. So rates on the rise ultimately is what's been weighing on investor sentiment. Now, it's interesting to see the longer dated accelerating to the downside versus what we're looking at now, the short dated, the 2, because that's kind of a reversal of what we had been seeing. Ken was talking about the flattening versus the steepening of the yield curve. And again, do want to point out that the 2, as you can see, not rolling over to the extent we're seeing in terms of the bonds. So now it's the longer data, which is really accelerating to the upside. Take a look. I've got that inverse look here now. Yields, again, with futures to the downside, rates are on the move higher. Here's the 30-year on the left, the 10-year in the middle, and the 5-year on the right, up to 2.76 this week, the 10-year to 2.64. But again, I'd keep an eye on the longer end here, the 30-year, if this continues. We also talk about the yield curve inverting. This has been a major factor. But, you know, we finally got some information yesterday as far as the Fed, something specific in terms of the taper, and you know, investors responded accordingly. I think that there's still a lot of unease, a lot of uncertainty in terms of the potential for a soft landing or lack thereof, and I think the indices yesterday were a pretty good indication of.
But the yield curve, which initially inverted, is no longer inverted, so we're not necessarily, you know, it's no longer flashing a recession warning, essentially.
No, and we talked about, again, the amount of time that it should spend there. It needs to stay entrenched. I think a lot of people kind of pointed to it's not necessarily just touching that inverted level. But then the other thing to think about, Caroline, is that's months away if it even happens. 18 to 22, I think, is on average. And then the other thing I've been hearing is throughout that period, the stocks tend to do pretty well.
Yeah. Well, Deutsche Bank, their forecast is for 2 years from now, but also calling for a 20% bear market, so not necessarily stocks doing well. Let's talk about gold and the moves you're seeing there, Ben.
All right, well, I think gold ran up strong in reaction to some of the geopolitical tensions and then came off almost as rapidly. We saw a lot of fear in terms of how Russia's President Vladimir Putin would respond to sanctions, and would he cut off energy supplies to Europe, for example? And none of that really came to fruition for the most part. Again, there was a little bit of kind of back and forth in terms of some of the rhetoric, but as far as actions on behalf of Putin's behalf, it was very limited, aside from the attack that he's had on Ukraine, which is a whole other story. But in response to sanctions, fairly limited. And I think that's why gold came off for the most part. Take a look at the price activity we've seen as we did pull back down below 2,000. And for the most part, well, there you can see the indices. But gold's been mostly sideways. Here it is around 1930. And again, we got an upper extreme 1970 now, a lower extreme of 1893. It's been supported around this 1890 level. But as we take a step back from this hourly time frame, I just want to point out, and I think this is what the bulls have really been speaking to, is gold is a way to preserve capital, and it has been historically. It continues to be, just most recently up to new all-time highs. You can see the geopolitical premium coming into play and then right back out of price there. I do want to point out that I oftentimes remind everybody that, well, in a situation that remains as tense as it is, we could be right back into these upper levels. It could be a headline or some sort of mishap in terms of some of, well, either rhetoric or some of what's going on in terms of the war that remains ongoing. So I think in terms of gold, it's something to consider. I'm also keeping an eye on it relative to rates, because with inflation concerns, gold gets run up. But then when the rates rally and the treasuries sell off and the TNX at these levels kind of puts a cap on some of that upside momentum in terms of gold.
What about in terms of crude, Ben? We're seeing it tick up about 1.2% today, still below $100 a barrel, though.
Yeah, it's funny to talk about crude at that $100 a barrel right now. Everybody seems very accepting and forgetful of the fact that we're a lot more comfortable with around 40, 50, and 60, but it does seem like something that's here to stay. We're just below it right now, though, Caroline, so maybe we're headed in that direction, hopefully, but there's been a lot to support crude prices at current levels, and one being demand is expected to continue, two being, well, geopolitical tensions at play, and as mentioned, everything that's going on in terms of Russia and the sights set there. But take a look at some of the weakness we've seen as of recent. As mentioned, back down below $100 a barrel. A couple things I'm watching here in terms of crude. Keep in mind, we recently had the U.S. release strategic petroleum reserves. We also heard from the IEA recently. They said basically that, well, they're going to do the same. The decision to release 60 million barrels from their emergency strategic petroleum reserves. You can see how that's kind of weighing on price. We oftentimes talk, though, about how with these reserves, that relief that we see in terms of price pressures is oftentimes short-lived. Take a look at crude coming off the recent highs. We saw up around 130. That was at the height of those geopolitical tensions to begin the month of March. One thing I've been looking at again, and we were just talking about gold, tying it back to the TNX crude on the daily time frame, you could see the run up. And just a reminder, as we've come off the pandemic lows, and here's where that comfort zone that we were just talking about, $40, $50, $60. So we're well above that, as you can see, and well, that feeds into these inflation concerns. Here, crude on the left, the run up off the again, pandemic lows. Look at a almost identical pattern in terms of what we've seen with the TNX. But hey, just a reminder, Caroline, to your viewers, it's not just crude, it's commodities in general. We were talking about ahead of the WASDE report, for example. Tomorrow, you can see how corn has remained very elevated. It's been holding upper levels. And again, if we were to compare corn with corn with the TNX, you'd see an almost identical situation. So again, it's commodity prices in general. It's not just crude, it's not just energy markets. Across the board, it's feeding into some of the inflation concerns.
All right, appreciate those insights and the perspective that, yes, just because crude isn't any longer at 130 or even 150, what people were calling for, it's still very high, historically speaking, and in terms of what we're comfortable with. Ben Lichtenstein, always appreciate it. Thanks so much. Coming up, we'll look into the world of small cap stocks and find out what names you should have on your radar. Stick around on the TD Ameritrade Network. Morning Trade Live. We'll be right back.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust the time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either Buy or Sell. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Welcome back to Morning Trade Live. I'm Caroline Woods, filling in for Oliver Rennick. It's time to welcome in Eric Kuby, Chief Investment Officer of North Star Investment Management Corp. Good morning, Eric. Great to have you here with us.
Good morning, Caroline. Great to be here.
So before we get into areas of the market that you like or see opportunity, first I want to kind of get your broader take on the overall weakness that we've seen this year, especially this week after some strength in March.
Yeah, I mean, it's been a really tough sledding for small cap stocks. Really starting March 15th of last year, really started struggling. Over the last that time frame, small caps have actually declined 14%, whereas the S&P is up about 14%. And we're playing a little bit of catch-ups earlier this year, but then down kind of 10% in a hurry this year. So very difficult stock market environment for the small caps, as they seem to be like in the focus of concerns over the recession and rising interest rates. So it's been a very tough sledding for small caps.
Despite the tough environment, your company has a couple of small cap funds. Why do you think small caps are the way to go right now? Is it a valuation play then?
Exactly. First of all, we generally like small caps. We think that the long-term history on small caps have been really excellent performance-wise. We think it's a great asset class, but they're at bargain prices right now. The businesses are, we just met with dozens of the management companies of our portfolio companies, and the business is really strong. They've got really good business results going on, and what's happened with this decline in the share prices as business has gotten better, they've just created some really terrific bargains. So, again, a lot of companies trading at single-digit multiples that are growing with great balance sheets. And again, talking to management, you hear quite a different tone than what you get out of the market. They feel very optimistic. A lot of the small cap managements are on their business prospects.
In terms of headwinds, though, this environment has many. I mean, there's obviously the geopolitical risk, there's supply chain issues, there's higher costs and prices, and so much that companies are up against. How are small caps in general poised to fare against many of those headwinds?
Yeah, I mean, again, it has our latest commentary. We called it the pick your brick in the wall of worry, because there's so much stuff to worry about. But again, talking specifically to a lot of these companies, I think that they've actually been really good and nimble. Small companies can be nimble at addressing these challenges. And again, these challenges aren't new. I mean, I think one thing that has to be taken into consideration is that a lot of the problems, with the exception of the horrible war, but a lot of the supply chain, wage problems, other issues, they've been going on for a while. So again, these companies have been addressing them. We think company by company, they've got good plans to address the struggles. And also, the problems haven't gotten worse. They haven't gotten better. So again, I think a lot of these companies had anticipated that by now that there'd be actually, like, the environment would be getting better. It's not necessarily getting much better, but it's stopped getting worse. And I think that they've developed good plans to address the higher wages, the higher energy prices, the supply chain issues. I think these companies have addressed these issues with specific game plans.
I want to go company by company, but one more quick question in terms of headwinds. One risk that could be new is the risk of a recession now, right? We're hearing more and more about that. Would a recession change your view on small caps, because they typically could be hit hardest first?
Yeah, absolutely. So we're much more positive about the future of the economy. I think for some of the reasons that you guys have talked about earlier today, you have a really strong labor market, really terrific pent-up demand. I mean, again, every company we talk to talks about the demand being at record levels. So we think there's really strong demand, and people are working. Interest rates, yes, they're going up, but let's remember they're going up like from a ridiculously, absurdly low level. So they're just trying to normalize those interest rates. But yes, to answer your question, our thesis on liking these companies is that the economy is going to be strong, that it's not, or it's not certainly not going to go into a recession. So we're more positive on the economy, and that's important for these companies.
Okay, so you have some thematic stock picks. You talk about the strong labor market. Well, two kind of play into that. First, employment and labor outsourcing with BGSF Inc. and Barrett Business Services, and then shoes, because people need to wear shoes to work, right? So you have Waco, Rocky Brands, and Boot Barn. Tell us why you like these.
Yeah, so that's, I think, those are all great examples of companies that have really good businesses that actually are very well set up for what's going on in the economy. I mean, again, there is very strong employment, and there's also a movement towards outsourcing those business services. So companies like BGSF, that provide staffing for technology companies, but also specifically multifamily residential, which is getting better as well. So I think that as companies are looking to hire people, and we're at full employment, these type of companies that provide employees are in extremely good shape. Barrett Business Services, does all the outsourcing for payroll and all the services that you do when you have employees, where they kind of take the employees onto their balance sheet and work through all those services. So again, more people working, more people looking for jobs, more outsourcing, really good for these companies, both trading at less than 10 times earnings with really good balance sheets and great growth prospects. So again, we think that's a really strong area with this really terrific jobs market. And then again, like you said, people want to, if you want to go to work or if you want to go to a concert or a show, you need shoes. So you got to wear shoes. And we think that shoes are, just the shoe businesses are great businesses. They wear out, so people have to, get new shoes. And again, the ones that we like, Rocky Brands offers a lot of work boots as well as some Western boots. Waco, which we visited with the other day up in Milwaukee. They have the Floorshine brand and a bunch of other shoes that are doing extremely well, and it's extremely well-run company. And then Boot Barn is a category killer. I mean, it's in the Western wear area, half their business is boots, growing. They just posted a 50% up quarter. So again, we think that people want to wear something on their feet. And we think that these stocks are all very inexpensive. Single-digit type multiples, great growth prospects, great brand names, and we think offer great bargains at these prices.
Yeah, it was a tough day when I had to stop working from home and come into the studio and start having to wear shoes again. Right. And I saw your note, the emerging theme you say of ESG investing may cause increasing interest in the utilities sector. What are your picks there?